Hi, Hunter Hastings here. When we think about wonderful entrepreneurial value facilitating businesses, which we do all the time here at the Value Creators, we don't always think perhaps about real estate. Maybe we think about real estate as a trading business. It's about buying and selling. Or we think of it as an asset business, assets to hold and cash in when they appreciate. But in fact, real estate, especially real estate for consumer rentals, is a wonderful value business. It provides end users and families with a home, with all the services that go with that. Shelter and warmth and protection, a place to cook, a place to sleep, a place to bring up your family. It's a wonderful service to provide. It's also a great entrepreneurial business where money can be made both in terms of cash flow and in appreciation, as we mentioned. Today's guest, Ivan Barratt, has been in this kind of value-creating business for decades. He's very successful at it. He loves it, and he's going to tell us all about his journey today, and we'll all get some tips about how we can be great real estate entrepreneurs.
This is the Value Creators Podcast. Value creation is the sole purpose of any business and every business, and for all of us as entrepreneurs. Listen to great value creators as they share their successes, trials, and lessons learned. Join us as we explore how to think as value creators, how to act as value creators, and how to do business through the lens of value creation.
Ivan, welcome to the Value Creators Podcast.
Thank you, Hunter. It's good to be here. Excited to get going.
Yeah, we're excited to have you here. We think about entrepreneurship, we think about value creation, and real estate isn't always the first thing that comes to mind when you're thinking about entrepreneurial businesses, but it's terrific value creation. You're helping others by giving them shelter and giving them comfort and putting them as part of a community and putting them near schools and all the things that real estate does. So we're going to think about real estate as an entrepreneurial business. And the best place to start, Ivan, is your journey. I've got a background on there. It says from 1 to 8,000, but that would be a great story to tell. So give us the quick history.
Oh, well, I already got a haircut. We gotta update that bio. We're approaching about 9,000 apartment units so far.
Excellent.
That did start off with a duplex where I lived in one side and rented the other side. And really, my story or journey of real estate goes all the way back to the late '90s, studying it in business school, then working for a mentor, and how I got my foot in the door with a big-time real estate developer was saying, "I will work for free. I'm here to learn, not necessarily earn." And so, by creating value for him, I was able to get my foot in the door. And of course, he would take care of me and pay me when I was able to sell something in his developments. In 2010, I decided that my path to having my own large company would be to start a property management firm and serve others and create value that way by providing a service to other real estate investors. And so I began on my own in my spare bedroom with a property management company, managing anything I could get my hands on as long as I didn't have to carry a gun to collect the rents. A few years into that difficult business, as I was growing it and dealing with employees and a lot of employee turnover, I was able to get a few key employees that are still with me today to help me figure out this question or find an answer to the question, how could we have a property management company and what would that property management company look like if people liked their job? And so we focused a lot on creating value for our employees, creating an environment where people liked their work, treating people who manage those properties and maintain those properties like they're worth the gold that they are. And that's been a not so secret key ingredient to our success. In 2014, 2015, we started doing our own larger real estate deals where we would buy apartment communities with a group of investors, and we would create value by forcing the appreciation is the term we use in real estate but we would create value in the asset by making repairs and making it a nicer place to live, attracting residents that would pay a higher rent. And we did that on behalf of our investors, so we created value for them as well. And we've been able to successfully execute that. 9,000 units later, we've got thousands of investors that invest alongside us. We've done just about 9,000 units, and we've delivered some incredible returns to our investors. So we've got lots of stakeholders at BAM, the residents that live with us, our family, the employees that work at BAM, now over 200 strong, and those thousands of investors that trust us to steward their capital, put them in great apartment deals, and provide those returns as part of their wealth and legacy and income strategy for their families. And it's a lot of fun. I get to work with a lot of entrepreneurs, a lot of business owners who are very busy, and they're hard at work in their own business, and being good husbands and wives and parents. They've got hobbies, they've got travel. They want to own real estate, but they don't want to deal with the residents and the toilets and the difficulty of creating value in property. And so it makes for a great partnership, Hunter.
Yeah. Well, that's a great story, Ivan. Thanks for sharing. I love your perspective of creating value in all directions, both the customers, the investors, your employees. If you've got happy employees, engaged employees, you can create more value for your customers. And I love that
Not so
perspective.
common sense that just seems obvious to me.
Yeah, well, obvious, and also you've proven it. So that's a great story. So, thinking about real estate as a business, I listed these kinds of questions. What's the cash flow profile? I.e., is this a good business to get into for cash flow? What's the return profile? Is it a return on investment perspective rather than a cash flow perspective? What's the capital appreciation profile? And what's the management burden? You mentioned some of those, but kind of think about the real estate business in general, as opposed to your particular company. How do you perceive it?
Absolutely. There's a lot of ways we could go there. So I'll start. We're very specific in our niche. We're focused on large multifamily housing. The other main food groups being industrial, office, and retail. We're very focused on our core competency. It is a very management intensive operating business, providing housing 24/7, 365 days a year to thousands of residents, a typical project being well over 200 individual units at a particular site, and those sites now span 7 states. So very management intensive. It takes a lot of work. Like any business, it is a game of nickels and dimes and pennies. And the value creation piece of it. Well, first I'll start with cash flow. So real estate can be a great cash flow business in that folks are paying rent every month. And if you're good at what you do, the rent that comes in takes care of all the expenses and the debt. And there's cash left over for distribution. Real estate, like any business, if you can improve it and you can increase the NOI, which is net operating income, I would say for your audience, that's most similar to EBITDA, but our earnings is based on NOI. And in the multifamily space, in Class A real estate like we buy, every dollar that we can get to the bottom line annually, whether we're raising rents or saving a dollar, is worth about $20 on sale. So we offer investors opportunity for income. And a lot of investors use their retirement vehicles to do that. We manage some private pensions. We manage a lot of retirement accounts through self-directed retirement accounts, through Schwab, through Fidelity, another big one called SEI, and many other custodians that manage retirement accounts. And then for folks that are looking for growth, that forced appreciation is very impactful. When you're doing it on a few units, the property is worth more. And it gets really fun when you're doing it for 300 units, or now in our current fund, we've got 1,600 units across 6 assets. And we've got the ability to raise that bottom line by probably about $10 million, which on value equates to another 200 million of value in that portfolio, which is the potential to double equity. Usually takes plus or minus 5 years to do that. Sometimes it can take 7, and the annualized or compounded return is a high teens. We just sold one for about 17.5% annualized over 7 years. So those investors got 2.6 times their money. And on the other end, when we can do it a little bit faster, we've done it as quickly as 3.5 years, where we've executed our value creation strategy, and returning that same 2.5 or 2.6x in 3.5 years puts the internal rate of return, or the compounded or annualized return, in the mid 30s, around 35% annualized returns on your capital. So as a private equity firm, whether it's business or real estate, the downside is your investment is locked up until we sell it. And for that, we give what's called an illiquidity premium, because we time the sale with the market, and investors get quite a large illiquidity premium above the market. And this trend really started at a big level with Yale's endowment. They were some of the early adopters of private equity real estate, and illiquid investments that usually take 5, 7, sometimes even 10 years. But that's how they were able to achieve those outsized returns versus public markets. And it's really caught fire through the pension endowment system, pensions. And now what we do is we can go direct, either through wealth management or direct to the investor versus the internet. And those investors can invest directly with us as the sponsor of the assets.
Are the multifamily units, are they individual investments themselves? I've seen real estate structures and partnerships where it's kind of one multifamily unit at a time, but you've also referred to a fund that has multiples in it. How do you structure those?
No, thank you for asking. So early on, we did one deal at a time. And as we grew our track record of performance, we moved into a fund format where we're buying multiple properties and sometimes multiple jurisdictions, and pooling them into a fund of assets. And we do that. It gives our investors a little bit more diversification. They're no longer taking what we call single asset risk. At the core, though, Hunter, it's still a partnership.
Mm-hmm. So it's equity, it's not debt.
Correct. Now it's a great question. We do offer some income and debt products now as an adjacent strategy to what we do. But the bulk of our competency and our product strategy is an equity investment in large apartment communities built throughout the Midwest.
Are you buying them new, or are you buying them already on the market?
Well, let's see here. So I think what you're asking is, are we buying existing assets, or are we building new ones?
Right. Sorry.
No. The bulk of our portfolio is we buy existing assets. So much like a business, maybe you've had somebody on that's rolling up plumbing companies or technology companies or any manner of companies. It's very similar. We're rolling up businesses into a fund that exist today, and those businesses happen to be apartment communities. We've also, as an adjacent strategy to our main strategy, and another way to create value for our investors, is we joint venture with real estate developers, and we build new projects to build them, lease them, and sell them, which is also another value creation strategy by taking a raw piece of land and putting 300 to 400 apartments on it with Class A amenities, pickleball, bark parks, resort-style pools and clubhouses, and the amenity list goes on.
So you've mentioned Class A a couple of times. You might explain Class A, Class B, Class C, and why you choose Class A.
Well, it's a little subjective, and if you ask a real estate broker, they're definitely going to go up in class on a given asset. But typically, a Class A is relatively new, 10 or less years old. It's got all the amenities that higher paying residents expect, like we just talked about. Class B is a little bit older, but still pretty nice. Maybe it doesn't have all the amenities or all the new items that new projects have, but it's right below Class A. A little bit older. Maybe the rents are a little bit less. A lot of people buy those Class B assets and try to turn them into Class A. And then Class C is a much older property. Typically, it's got some functional obsolescence. Maybe the ceilings are low or the floor plans are small. Maybe it doesn't have the amenities of some of the newer assets. And it may rent to someone that's a little more stretched on their credit profile.
Yeah.
We used to do that sort of thing as well, but we found our niche and the most value we can create with our management team, who is exceptional at the operations, by buying newer assets, typically from mom and pop operators who might not have the economies of scale that we do, or other owners of assets that have hired a third-party property management company who might not be doing a bad job, Hunter, but they're not doing a great job either, and there's room to improve the operations.
Yeah. So we look at it through the lens, Ivan, of choosing your customers. You choose your customers, know them well, understand their needs, and then serve them excellently. So it sounds like in Class A, you're choosing your customers, right? They're customers looking for a certain level of quality, of comfort, of location, of community. Do you look at it through that lens?
Absolutely. I love renting to customers who care about their credit score, pay their rent on time, take care of their unit. Now, they expect a lot of service in return for that, but it's a great relationship, very symbiotic. And then our investors, who like high returns but also like to limit risk, also recognize the lower risk profile of newer, nicer assets that rent to nice people that, again, care about their credit score.
I know that one of the variables that you look for in managing these multifamily units is percentage occupancy, and that can sometimes fluctuate with economic conditions and so on. How do you manage that? Are you always marketing availability, or are you retaining the ones who are in there?
Well, apartments, by definition, the sector's fairly transient. And
Yeah.
so we typically are turning over 40% of the residents yearly.
Wow.
Versus, say, student housing, where they're turning over nearly 100% of their customers on a yearly basis. So it's still quite transient, and the lease average is 12 months. And the name of the game, though, is taking care and keeping as many of them as you can by providing great service, great maintenance, being very responsive. But we're always marketing for new customers in several different ways, both on site and online and through various publications.
Do you keep a waiting list? Do you have an inventory of waiting people?
Oh, the waiting list was definitely live and in effect coming through COVID, as there was a lot of demand for the product we owned. Now it's more normalized. Occupancy typically is going to be around 93, 94% for these large deals. And the saying in my game is, if you're 100% occupied, your rents are too low.
Yeah. So how do you think about pricing when you're buying these properties, Ivan? We always talk about it as a discounted cash flow of future value. So we're creating value for these customers over the years. You discount that back to the present day, and you choose the price that'll give you a good return on that future cash flow. But maybe in your business, it's more transactional. So how do you think about pricing?
On the resident side, for sure, but my main customers are the over thousands of investors that are invested with us.
Mm-hmm.
They've got their hard-earned capital that we're now stewarding, right? So we have to be very diligent on how we approach pricing when we're buying those assets that we're going to seek to improve. We can change a lot with a business plan, Hunter, but the one thing I can't change is how much I paid for the asset.
Yeah.
So sometimes we lose out on deals because we're not willing to pay even just $1 million more on say, an $80 million deal. we might walk away if the price goes to 81 million.
Yeah. I've heard my friends who are in similar businesses to yours, not quite at your scale, but that the big institutional investors, the big private equity firms, the Goldmans and the Morgan Stanleys and so on like that, are out there buying and they're inflating the prices for multifamily buildings. Is that your experience?
That can absolutely happen. There are markets where it is virtually impossible for me to get a deal that makes sense for my investors because the Blackstones, the KKRs, and the Brookfield asset management groups are paying. I wouldn't say they're overpaying, but they might need a lower return than my investors require, and therefore they can pay more for that asset. And when that happens, we have to continue the search. And so we look for markets where they're not currently looking to find value. It is a never-ending game, studying the market and figuring out if we can be rewarded for entering that particular market.
Yeah. So just dialing the clock back a little bit, you didn't start with an investment fund. You didn't have the financing that you have now when you went from living in one side of a duplex to the next step. And the next.
Definitely not.
What's your advice for finding financing and funding at that stage when I want to go from one property to 2 or 5 or something?
Yeah, so property management for us is a loss leader. So margins in property management are quite small, almost as bad as a restaurant. And what we discovered is instead of being miserly with that small amount of profit, we use that to reinvest into the company, into the people, the events we put on, our conference once a year where we fly in everybody for education and learning and to be together. We throw a big Christmas party. I think I'm still recovering from it this weekend. And so we invest a lot in our culture. And what happens is we don't make a lot of money in the property management operating company itself, but it generates this beautiful machine of people that executes the wealth strategy for our investors. And that's where the true value creation comes.
Yeah. Yeah. So as we were talking before about cash flow, you're using some of the cash flow presumably to pay for that management service, and it reappears as return on the invested capital because of the quality relationships that management produces. Would that be accurate?
Sort of. So the management fee in any property that's managed, whether you hire someone to do it for you, you do it yourself, there's typically a management fee involved. And that management fee is a business expense to the property. And the management company collects that fee along with payroll and technology and other expenses that the management company charges for the daily management of the asset. And so that's profit to the management company. But that profit gets eaten up pretty quickly.
Yeah.
Yeah.
We're delighted to announce the Value Creators online course. For entrepreneurs in every kind of business, big, small, or medium, at every stage, in every industry, our course provides the foundations and principles on which to build success. Simple, clear purpose and principles give rise to creativity, innovation, and competitively superior business action. There are 11 foundational principles or mental models that together cohere into the value business model. Principles for value generation, principles for value operations, principles for value finance and accounting, and principles for value sustainability, as well as the new knowledge accumulation you'll need for continuous innovation. These principles are delivered by top business professors from top business schools: Mark Packard, Per Byland, Gordon Miller, David Rapp, and Bart Vanderhagen. You'll find video lessons from them, along with downloadable tools, processes, and other valuable content. Master these lessons, and you'll master the most important skill in business: value creation. Go to thevaluecreators.com and click the course link. So the other thing we think about all the time as economists, Ivan, is economic fluctuations, booms and busts, and
yes,
nobody understands them. But we always hear at the real estate sector is at the center of that, either as the causal factor or the sufferer of the consequences. What's your experience of economic ups and downs, and how do you manage it?
Well, it's gosh, this has been my third correction in my career. My first one being 2008, which went on for several years, and I was a little fish then, and so was able to put together a little bit of money and buy some small deals, and made a killing percentage wise, but not a lot of dollars because they were small deals. But that was the start. We had a small correction the first 2 quarters of 2020. COVID caused a deep correction, but a quick one before everything bounced back with a fury. And that was when we were putting our first fund together. So we were able to take about 45 million and buy 150 million of real estate, and did incredibly well at that in that vintage, or the time that we acquired those assets. And now we're in another correction where similar things have happened, but it's been longer. And this one is thanks to the meteoric rise in interest rates that happened faster than any time in central bank or Federal Reserve history.
Mm-hmm.
And that caused a lot of disruption to the market, and created or presented some amazing buying opportunities. So on one side, I haven't sold anything up until this week. We hadn't sold anything in 2 years because it was an incredible buying opportunity, but a very bad time to sell. And just as in 2008, if you could hold through that, you did quite well afterward with values. It was the folks that couldn't hold and were forced to sell that took losses. And similar to today, we've been able to pick up some great assets. We've deployed almost 220 million in capital the last 24 months to buy just north of $500 million of real estate, 200 million of equity, and also the leverage from the banks to buy these assets, just like you would buy a home with a mortgage or a small apartment building. We put mortgages on the big ones too. And so these winters, these corrections, they always come.
Mm-hmm.
It's interesting seeing people that haven't experienced that, or some younger participants thinking that trees grow to the sky, or that this time it's different. And these corrections inevitably occur. And if you're set up to take advantage of that, it can be a great time to buy assets. It can also be a very difficult time for a lot of my brethren who maybe were new to the market and smart and well-meaning, but put together what I would call a skinny deal with a pie-in-the-sky pro forma. And those folks are learning the hard way right now that this game, like any other game of entrepreneurship and business and value creation, might be simple, but it is anything but easy.
Yeah. Just explain to us, Ivan, how interest rate fluctuations affect your market and the liquidity in your market. So we understand what happens to mortgages. It's more expensive to get a mortgage, so maybe people don't buy when interest rates are high. But it sounds like the mechanism is a little bit different in your business.
Well, interest rates can affect multiples that people are willing to pay for income generating assets, whether they're businesses or real estate.
Yeah.
So multiples in venture capital, in all sorts of sectors, including real estate, have come down. They got irrationally exuberant in 2021, 23. Well, more so in 21 and 22, excuse me, and really started coming down at the end of 22 through 23 and 24. And so multiples are down. If you've put together a very skinny deal and now your deal is worth less than the debt you owe on it, you've got a big problem. If you're in a better position with liquid reserves and are able to hold through that, rents are still increasing, and interest rates will come down and normalize. And so there'll be opportunities to harvest, but folks might have to wait a little bit longer than they thought. Whether they're looking to sell a piece of their business, sell their entire business, or sell a large apartment project, as in our case. And we're starting to see that market equalize out a little bit. We're very excited to sell an asset just this week and plan on selling, I would say, 3 to 5 more next year. I think we'll still be net buyers for the next couple of years because there's opportunities where folks either need to sell or are forced to sell for various reasons.
But it sounds like you're doing both at the same time. You're buying and selling, right? Different calculus, maybe.
Typically, Hunter, we're trying to do both, and that's a pretty good year where we bought a few and we sold a few.
Yeah.
The last 24 months, we've been on a buying spree only and not sold anything.
Yeah, so it's interesting to think how you manage those cycles, and
it's a cyclical business, no question.
Yeah. Well, it's important to get into. So,
what's fun about it though is if you can play the cycles, right? If you can have the capital and raise the equity and still get the debt financing, which is very difficult to do right now. But if one is able to do that, the deals are quite exceptional. There were a couple assets we were able to buy where we were literally the only qualified bidder at the table putting in an offer. And that, by definition, keeps the price favorable.
Can you raise anticipatory funding or capital where you say, hey, we don't have an investment right now. We have a great formula. We know we'll find one. So put the money in the fund and we'll invest it later.
Absolutely. That's the advantage to me for having the fund versus raising it asset by asset. I can increase my fundraise runway and I can have more capital, my own and my investors, built up and ready to go. And that is a significant competitive advantage in times where there are more opportunities than equity.
Yeah. Yeah, that's brilliant. So you're not in the commercial real estate business, I take it. Maybe you are, but it doesn't sound like it.
Technically, multifamily is considered commercial,
okay.
But it's only because of its size and how it's valued versus an office building with businesses in it, a retail asset with businesses as tenants, and same for industrial. So we are commercial in our technical definition, but we are still renting to people. So calling it residential doesn't hurt my feelings.
No, but where I was trying to go was you're not in the office business, you're not in industrial, as you said, you're not in data centers, which I know is a big real estate growth area.
One trick pony, Hunter.
Yeah, so I was going to say, explain to us why you wouldn't be in that business, but maybe help our listeners think about, is there opportunity there and in what circumstances?
Well, I really like what Robert Kiyosaki says about this. I still am a fan of some of the things he used to say. He's gone a little crazy these days in some of the things he says. But he would say, any investment can be a bad investment if you're a bad investor.
Yeah.
And so I think there's opportunities, and I'm always fascinated in all the different ways that people create value and make money for themselves and their investors, whether it's real estate or business. But for me, I really like residential, no matter what happens in the economy, whether the sub shop is open or closed, or the nail salon or the business renting industrial, deep recession or growth, there are people that need a rooftop over their head. And that is not something that's going to be disrupted. People will always need a rooftop. And so that takes a measure of risk off the table.
Yeah. Yeah, that's the definition of creating value, right? You're providing something very fundamental, which is shelter and comfort and location.
I've still got to nail a lot of other things: market, feasibility, management, supply. If I go into a market with too much supply, that can hurt me. There's 1,000 other things to look at in boxes to check. But people demand a place to live all across the country.
Yeah.
And the cost of owning a home now, I actually, even as an apartment guy, I hope that that normalizes. But there is a Grand Canyon of space between what it costs most people to rent versus buy now.
Well, the other question there is whether that's a social trend, whether I understand the financing, people can't afford homes, but maybe the cliched American dream concept of I must own my home is being replaced, and it's smarter to rent. You can get better facilities. You got more flexibility. Maybe there's a trend towards that.
There might be, and it's a good idea to recognize the trend. The trend is my friend, right?
Mm-hmm.
But there's still a part of me that is hopeful that the majority of our country will have access to own their own home if they so desire. And people that buy homes, they buy cars and washing machines and refrigerators and lawnmowers and all the other things to go with that little piece of the American dream. And it is a forced savings account for a lot of people. Now, is it a great investment? I would say no. But for a lot of people, it is a forced savings account, and a lot of people need that. And so even as an apartment guy, I still hold out hope that the vast majority of the country right now, 60+%, will continue to be homeowners, and we won't be Europeanized to where home ownership falls to sub 50%.
Yeah, that's why they call it the American dream, right? It's not the European dream.
I hope so. I hope so. Yeah, it's funny. I mean, I've got a brother in the UK. He bought his first home. He's a year younger than me. Bought his first home a couple years ago. Him and his family, his wife and kids, have been renting till now.
Yeah, it's as you say, much more normal way of thinking over there. So a final question. We ask this for everybody, Ivan. Everyone's thinking about AI and what it's going to do for their business and how it's going to increase productivity and automate and make decisions. How do you approach thinking about the future of AI for your business?
I think it's inevitable. Big picture, I think it will make the wonderful humans that are in our family that help us execute our wealth strategy. I think it will make them much more productive.
Mm-hmm.
And I think it will offer some really unique benefits to folks that are looking to get to know us and other customers. It's going to change the world just like the internet did, just like the wheel did, just like fire did. It's a big, big change for the future.
One of the ways we've come to think about it is as an additional team member. So you said it's going to help your management team, and maybe we'll get to the point where the team is 3 people and an AI, and they're colleagues and they work together and they help each other and they've got their different specialties. I think that's a possibility.
I see that as more of an after hours thing. My business is becoming quite commoditized. I think everybody's got the resort style pool and the clubhouse, and the bark park and the pickleball. I think the differentiator is going to come down to the people on site who help create a community. And I think that'll be a differentiator in a world of AI and automation and no one sitting behind a desk. I think those folks that create that human connection could have an advantage.
Yeah. No, I think you're right. There's the human in the loop, as they say, is critical. I agree with that. There's also rumors about the AI CEO, Ivan. That's the decision-making CEO will become an AI.
Oh, wow. Well, hopefully I won't be replaced anytime soon, but I find that sort of AI hard to believe.
Yeah. Well, thank you for this tour of the real estate business. I don't know if there's anything more that you want to communicate, but you're obviously a brilliant investor, a brilliant manager of your properties. You're a team builder. You're a service provider for all those people renting your apartments, and you seem concerned about their experience of value. So we thank you for sharing all of that.
Those are some of the kindest words I've heard all day, Hunter. Thank you. I appreciate you saying so. It's been an honor to be here. You can find me easily at bamcapital.com, and I love talking value creation and entrepreneurship. So hopefully we can chat again soon.
Good. Can people find you on LinkedIn if they want to?
All over LinkedIn, the YouTubes, and bamcapital.com. If you Google my name, Ivan Barratt, Barratt, I make myself pretty easy to find.
Good. Perfect. Well, thanks for being with us today, Ivan.
The pleasure's all mine, Hunter.
This has been another episode of the Value Creators Podcast. Thanks for listening. You can visit thevaluecreators.com for links and resources related to this episode. And check out hunterhastings.com for more content on entrepreneurial business management based on value creation principles.